Well, dear students, I told you that we're basically finished this semester, but not really. We have some odds and ends and some items that you need to learn about, but hopefully you won't ever participate in them. And the first one is options. Instruction about syphilis is not an instruction to get syphilis. Right, that's why we have that education, so you don't get it. And that's why we're teaching you about options, because they are gambling, short and sweet. And there are people who will disagree with me, and there are a few situations where they may make sense, but no, 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 no. But hey, we got to learn about them, right? Because you are going to be, you already are the investment gurus for your friends and family and coworkers. And so when they come to you and say, hey, I hear you can make a lot of money with options, you're going to temper their enthusiasm and thwack them generously. And hopefully they'll listen to you and not gamble. So let's start with a joke. I believe it's attributed to Warren Buffett. And you might not understand it, but later you will. At a very exclusive party, a high class, finely clad woman slinked up to the CEO of a Fortune 500 company and said, I will do anything, anything you want. The CEO flatly responded, reprice my options. Now, that probably isn't funny to you, but you'll understand later on what he meant. Slide number 2. Slide number 2. Okay, good. What is an option contract? Well, an option that's we usually just call them options, but the real term is option contract. It's a security. That means it can be traded, right? It's a financial instrument, a financial vehicle. A security that gives the holder the right to buy or sell a certain amount of an underlying financial asset at a specified price for a specified period of time. Wait a minute, what? You're not buying something, you're buying the option to buy it. Yes, that's exactly what you're doing. Or the option to sell it. And there are options on many different items, but we'll just refer to stocks in our presentation just for simplicity. Options contracts are not investments. They are contracts. They are agreements between two, we use the term loosely, investors. We should say between two speculators, between two gamblers. The buyer of the option contract gets the right to buy or sell the financial asset at a given price for a given period of time. Whereas the seller of the option contract, the person on the other side of the agreement, must buy or sell the asset according to the terms of the contract. So by now, you're probably thoroughly confused. What are these things? Stick with us because the lights will start going on and off and turning back on again. You're not actually buying the asset. You're just saying, I want the ability to buy the asset. But to make matters worse, there are contracts to sell the asset. So it's like a mirror, and hopefully we'll be able to see both sides of the mirror clearly. Options contracts are part of a class of securities called derivatives. Remember back in chapter 1, we said derivatives are securities that derive their value from the price behavior of an underlying real or financial asset. So the derivative uses something else to derive its value. Options contracts have no voting rights, they receive no dividends, no interest, and eventually, poof, they just expire. Their value comes from the fact that they allow the holder of the option to participate in the price behavior of the underlying asset with a much lower capital outlay. So we can follow the price of, in this case, stock, and come up with a whole lot less money. By the way, options contracts are usually just referred to as options because it's not easy to say options contracts. Try saying it 3 times quickly. It isn't easy. So we'll just say options, okay? But you know that they're contracts. They're not stocks, they're not bonds, they're the ability to buy a stock or a bond or some other thing, but we'll just use stocks. So they are agreements between two speculators. Options allow an investor to leverage their outlay of capital. There's that word again, leverage is the ability to obtain a given equity position at a reduced capital investment, thereby magnifying your returns and your losses. With options, you can make the same amount of money from a stock or other security as if you bought it for full price, but only come up with 1/10 or less of the money. Wait a minute. Sounds too good to be true, huh? Yeah, well, you're right. It is too good to be true. Much of the time, you lose your entire outlay. Options have a time limit, and most options expire worthless. So, sure, it sounds exciting. Whoa, I can make the same amount of money with 1/10 of the outlay, but typically you lose, and you often lose everything. Yeah, but I didn't come up with a whole lot of money. What difference does it make? But it reminds me of people go to Vegas and go, "Oh, I lost $200." You lost $200, but I had a good time gambling. Okay, fine. Okay, fine. If that's your way of enjoying yourself, great. But if you're trying to build wealth, no, it's not a smart thing to do, in my humble opinion. So, what's the rationale for options? Slide number 5. Instead of buying a stock, you buy an option to buy a stock or an option to sell a stock. If the stock goes up, your option will go up almost always much, much, much faster. And then you can sell the option for a handsome profit or exercise the option and actually buy the stock. But there's only one catch. The option expires in 3, 6, 9 months. If the stock does not go up, your option is worthless. And surprise, most options expire worthless. There are some scenarios where options can be worthwhile, dear students, but they are few and far between, in my humble opinion. Slide number 6. So let's take a look at an example. This is a very simple example, and I often on the board will draw $20 and then a dollar, and so we don't have that option here. But no pun intended. We don't have that ability here. But think about it. You buy a share of a stock for $20. Stock goes up to $30. Yippee! You've earned $10 on a $20 investment. What is that? If you do the math, that's a 50% return on your money, right? Pretty cool. But instead, you buy an option to purchase a share of stock at $20 that's currently selling at $20. You don't buy the stock, you buy the option contract, and it might only cost you $1. So you pay $1 for the option to buy a stock at $20. Now, what if the stock zooms up to $30? Your option price will zoom up to around $11. It will follow the price of the stock. So you earned $10 on a dollar investment. That's 1,000% return on your money, dear students. That is leverage in action. Congratulations. Pat yourself on the back. Doesn't that sound what you wait a minute. Slide number 7. What if the stock price stays at 20 or goes down to 19 or whatever? Your option expires worthless. That dollar you paid is gone at the end of 3, 6, 9 months. And of course, after your option expires, the price zooms to $40. You were so sure that the stock was going to hit the big time, and you were absolutely right. But because you bought an option that expired, you lost the ability to share in the success of the stock. So my advice, for what it's worth, forget about the option. Forget about options in general. Just buy the stock. But since this is an introduction to investments class, we need to become proficient in the concepts, terms, and techniques of options. Remember, instruction about syphilis is not an instruction to get syphilis. So let's get started. There are two main types of options, and this is where it drives people nuts, folks. I mean, this is one of the toughest parts of the Series 7 stockbroker exam because there are call options, and you've heard that term before. Remember bonds, callable bonds? And there are put options. The call option is a negotiable instrument, a security, that gives the buyer of the option the right to buy the underlying security at a stated price. And the previous example that we talked about was a call option. And that's what people usually, if they don't say put option, they usually, when they say option, they mean a call option. When people talk about options, they're usually talking about call options. But there are put options. Put it to somebody. That's a negotiable instrument, a security, that gives the buyer the option the right to sell the underlying security at a stated price within that time period. It's the opposite of a call option. So on the board, when we're in a face-to-face class, we would create this thing right here. This is out, it's in Canvas, it's on the website. I call it the option worksheet or option scramble sheet or whatever you want to call it. And I tried to draw this as a mirror because the two are mirror images of each other, and that's where it gets really tricky because on the Series 7, when you take the stockbroker's exam, they're going to ask you about a call or a put, and there's going, depending on which way you go, if you go up or down or whatever, if you zig when you should have zagged, you'll get a different number, and of course that's one of the choices. So you really have to know this stuff. So I think you might want to stop right now and print this out so that you can watch it as we go through these two different types of options. The call option, the right to buy; the put option, the right to sell. Okay, so where did the terms call and put come from? How will I remember which is which? Well, the term call comes from the idea that when you buy the call option, you get the right to call the stock away from the seller. Come here, stock, come on, come here, come to me. The term put comes from the idea that when you buy a put option, you get the right to put the stock. Here, take this, put it to you. A call option allows you to call the stock away from somebody, buy it from them. The put option allows you to put the stock to somebody. So let's look at each in detail. The two parties, remember, it's a contract, it's an agreement. There are two people on either side. Your broker's in the middle. Your broker is facilitating, but you're not buying it. Well, sometimes the brokers actually will have people in their office who will take the other side of your call, of your option, of your call or put option. But typically, no. All they're doing is facilitating it. So somebody out there is on the other side. The buyer of the call option buyer, is the person who will, they don't have to, call away the stock. They buy the right to buy the stock, call the stock away from the seller of the option. They don't have to exercise that right. In fact, often the options contracts expire worthless because it doesn't make sense to buy a stock for $160 when it's currently selling for $150. I'd rather buy it at $150. The seller of the call option is the call seller. But here's where it gets tricky because it's also the call option writer, the call option maker, the option writer, all three. Option seller, option maker, option writer, they're all three to make matters worse, right? You got to learn all three. And the call option seller of the contract is the person who must sell the stock. It'll be called away from them. They're legally bound. They entered into an agreement that they would sell the stock at the price that they agreed on. In return, they get the premium. They get the option price for the call option buyer. So, what is the call option buyer hoping for? They're hoping that the price goes up. They are bullish. So, for example, the example we used, if the call option buyer had a call option to buy at $20, that's called the strike price, by the way, the exercise price, and the price goes to $30, they then can exercise that option. They can say, look, You said, Mr. Call Option Seller, Ms. Call Option Writer, Ms. Call Option Maker, that you would sell me this stock at 20 bucks. Now I know it's selling at 30, but I don't care. You made an agreement that you would buy it from me at $20. So I can buy it at $20, turn around, sell it at 30. Very cool. If the price goes up. But what is the seller hoping for? What is the writer? What is the maker? They all mean the same thing. The call option seller is hoping that the price of the stock will go down or at least stay the same. So the call option seller is bearish or maybe just not very bullish. So if the stock stays around 20 or goes down, the call option buyer is not going to bother to exercise the option. It will expire worthless, and the seller gets to keep the price of the option, the premium. You see, it's a contract. There's a process going on here. So here's an example where we have Ed and Ted. And Ed is the call option buyer. He pays the dollar. Where does the dollar go? Goes to Ted. And now Ed, for 3 months, 6 months, 9 months, whatever, he has the option to buy that stock at 20 bucks, no matter how high it goes or low. Of course, he wouldn't buy it if the price went down below $20. That would be stupid. You could turn around and buy it for 15 bucks if it was selling for 15. So the call option buyer wants the price of the underlying stock to go up. He is bullish. No matter what happens to the price of the stock, he can buy it from, call it away from, come here, stock, the call option seller for $20. The call option seller wants the price of the underlying stock to go down or stay the same. If it stays at 20 bucks, he wouldn't bother exercising the option. He is bearish. No matter what happens to the price of the stock, he must sell it. He is legally obligated to sell the stock. It'll be called away from him at the $20 strike price, exercise price. The call option contract is tied to the underlying stock. It's not the underlying stock. It's a contract. It will vary up and down as the stock varies. So you get the idea here? These two people are making a handshake. They are making an agreement. This guy is saying, I'll pay you $1. Okay, I get the dollar. This guy's saying, okay, no matter what happens, the price of that stock, I will sell it to you for $20. Even if it goes up to 100, I still got to sell it for $20. And if it goes down to 15, whoops, I didn't mean to do that. If it goes down to 15 or 18, then this guy's not going to exercise the stock, the option. Doesn't make sense to exercise an option for a stock that's selling for less than that $20. So that's what that guy's hoping for, because then he gets to keep the buck. He gets to keep the buck no matter what, but he might wind up, if the stock price goes up to 100, yeah, he's in deep kimchi. All right, continuing. Now let's take a look at the mirror image, and this is where that sheet should help you. There's a put option. The buyer of the put option is exactly opposite of what the buyer of the call option is. The buyer of the put option is hoping the price goes down. She is the person who will do the putting to. They will put the stock, sell the stock to the put option seller. They don't have to exercise this option. And did I say that many option contracts expire worthless? Yes, I think I did. Now, what's the seller? What's the maker? What's the option writer have to do? They must buy the stock. It'll be put to them no matter what if the put option buyer exercises the option. So the put option seller is legally bound to buy the stock from the put option buyer. And of course, they get that option premium, that option price that the buyer paid. So it's the exact opposite. What is the put option buyer hoping for? The put option buyer is hoping the price will go down. A put option buyer is bearish. If the option buyer has an option to sell at 20, the price goes to 10, whoopee! He can sell that stock at $20 that's only selling for $10. So he can buy it at 10, turn around, sell it for 20. You see, very cool. Or he doesn't even have to exercise it. He could turn around and sell the option before it expires. What is the put option seller hoping for? The put option seller is hoping that the price of the stock will go up or stay the same, and the put option seller is basically bullish or is not very bearish. If the stock stays around 20 or goes up, you see a mirror image of before, the put option buyer will not want to exercise the option and it will expire worthless. And of course, no matter what, the put option seller, put option maker, put option writer gets to keep the premium, the price of the option. So, same idea, but in reverse. Fred pays $1 to Ned. The put option buyer wants the price to go down. He's bearish. No matter what happens to the price of the stock, he can sell it to the put option seller for $20. The put option seller wants the price to go up. He is bullish. No matter what happens to the price of the stock, he must buy it from, put it to, right? He would put to him, the put option buyer for $20 if the option is exercised, which it doesn't have to be. The put option contract is tied to the underlying stock. It varies up and down as the stock varies. Oh, time for questions on options. Options are confusing, huh? Yeah, it's true. They are one of the toughest parts of the Series 7 stockbroker exam. And we have a worksheet which has questions that are very similar to the type of questions you would see on the securities exams. Options sound like gambling. Am I right? Yes. No, you are right. They are gambling. It is a zero-sum game. Someone wins, someone loses. With stocks, that's not true. You know, the pie can get bigger and everybody wins. Now, obviously, some people won't. Some companies are going to go bankrupt. But in general, stocks are not a zero-sum game. The pie can get, I said that already. I'm repeating myself. Everybody can win. Everybody's not going to win. But with options, one person wins, one person loses. It's that easy. And of course, the brokers make money no matter what. A family acquaintance once called me. Say, Frank, I hear you can make a lot of money investing in options. I said, whoa, wait a minute. You can make a lot of money, yes, but you can lose a lot of money. You can't invest in options. You can speculate in options, gambling, but you cannot invest in something that has a 60% chance of being worthless in 3 months. That's not investing. Remember our original definition of investing? Some vehicle that we put resources in with the reasonable expectation that we're going to gain or get in or cash flow, interest, dividends, rent, whatever. This is not a reasonable. This is 60% chance. Now these numbers are debatable depending on who you talk to. I believe. Excuse me. I believe that the people who say about 50 to 60% of options expire worthless are right. There are some people who say, oh, no, it's only about 10%. And there are other people who say, no, it's 90%. I think those numbers are out of whack. The 10% number is, guess who says that? They're the people, it's the options, the folks who are selling, who are the exchange for options, Chicago Board of Options. And so they want people to believe that, yeah, options are a great way. And then the 90%, I forget where that comes from, but that's too high. Most options do expire worthless because it just doesn't make sense. If you have a $20 call option, you can buy the stock at $20. But if it's selling for $18, why would you buy it for $20 when you could buy it on the market at the market price of $18? And that's what happens. Okay, so go back over this because I know you didn't get it the first time. I certainly didn't get it the first time. I was like, what is this? In fact, I was introduced in options at the brokerage firm I was working as a computer nerd a million years ago. And my boss, Frank, his name was Frank also, I said, these things seem like gambling. He said, they are gambling. And I said, oh, okay. That was my introduction. So I'll do the same to you. They're gambling. Stay away from them. But when we come back, we will continue our discussion of the intricacies of options. So the reality is, dear students, if you're hard pressed and really are at the end of the semester and you're trying to scramble to catch up and whatever things are going on with your life, the quiz, the exam, the final exam will have the questions on options available to you before the exam. So I'm not telling you not to go through the presentations because you are the investment gurus for your friends and family, so you should know this. But yeah, you can tell I certainly don't ever want to. I've never bought an option. I don't think I ever will. If I ever do get involved with options, it will be as the option writer, the option seller, the option maker. But that doesn't mean you still can't lose very big, which you can, and I don't like losing. So, hope to see you at our next presentation. But if I don't, oh well, you know that on the exam there will be no questions and no calculations about options, and the questions will be given to you before the exam. Cool? Okay. Hope to see you in our next presentation on options, where we go into more detail about these cursed animals.